It's Sunday, April 25th, 2021. This is All About Your Benjamins and your weekly mixtape. Hope you had a great week. Let's get to the headlines that may or may not be impacting your financial plan and portfolio. And as you can see, if you're watching this on allaboutyourbenjamins.com, only a few headlines to run through. Nothing too crazy and major to hit on, so let's just get right to them. We'll start off with some of the numbers we're always tracking month to month and just talk about them a little bit. First one is unemployment claims continue to go down and hit a post-pandemic low, but unemployment numbers are still above where they were pre-COVID. So just under 550,000 people filed for unemployment. It was down maybe 39, 40,000 claims, maybe a little bit more. I forget the number. Doesn't matter. It's down, trending in the right direction, which is a positive sign. So as the last handful of weeks, we've talked about how the economy is rebounding, getting stronger. There's optimism about where we're going with the economy, which spills into the market. So that trend continues to go, and the next couple of things we talk about as well feed into that. So unemployment numbers continue to improve, and I've got to imagine with summer coming up that those numbers will get better. More seasonal jobs will come back. Seasonal jobs being outside, better opportunity for people to pick up some work if they've been missing out on that. So positive front there. The next one, I'm sure you've seen or you've heard somebody buying or looking to buy a home, and right now inventories are very, very low, which is driving the prices of real estate up in most areas. So I'm hearing about people paying well over the market price, even just not just the ask, but the market price for housing because they want to get into it. Deals are closing very fast, and there's just not enough homes out there for people who are looking to move. Lots of reasons people are looking to move. COVID, getting people out of the cities, wanting to have more space, realizing being cooped up in an apartment or a condo may not be what they want. People have seen their financial positions, as crazy as it may be, improve over the last year. So now they're sitting on the ability to be able to upgrade or just buy their first house, and interest rates being real low. And there's lots of other factors there as well, but those are the main ones if you think about why people might be looking to buy homes, and just not enough out there. So not saying that there is a housing bubble like we saw back in 2006. I remember those days. Didn't realize what was going on then, just because that was my first couple years out of college. My wife was actually selling new homes, and looking back, it's obvious the things that were going on there were not very smart and very good. Different situation today, it's just more supply and demand. So we'll see if home builders are able to meet supply, and then what that could mean long term for housing. But right now, housing remains hot. So do you rush in? Do you try to time? Just like any investment, you're never going to know when is the market going to cool off. So there will be people who go out and they'll buy their house and things will cool, and they'll see their property value drop or remain the same and not appreciate like it has over the last year. But if you're going in to buy a house, you should be thinking about it not so much from an investment standpoint, more from it's a house, it's housing, and not so much for trying to make a quick buck on the house. My opinion. Now, if you are a real estate investor, totally different situation, but if you're buying a home for your primary residence, for your family, you go into it thinking, I'm going to be in this for a period of time. It's not so much to make money rather than to have a better house that fits your needs better. Again, and take advantage of low interest rates, but realize that's going to come with a cost today, and just be prepared for that. Moving over to the investment realm, this week we saw the market sell off a couple days. Not a big deal. They weren't huge sell-offs, but one of the storylines that are being highlighted and tied to the market selling off is President Biden's plan to propose raising capital gains taxes. So we'll go do a real quick investment 101. Capital gains taxes, what are they? Capital gains taxes apply to investments that are held outside of your retirement accounts. So if you have an IRA, if you have a Roth IRA, if you have a 529 for your children's college, if you have investments that are tax sheltered, this is not going to apply to you from a tax standpoint. It could apply to you, the impact from what the markets may do as reaction, but the capital gains tax applies to an investment in a non-retirement account, and then depending on how long you hold it, if you hold it for less than a year and you sell it for a gain, you have a short-term capital gain tax, which is just your income level. So nothing really being talked about there changing. It's the long-term capital gains rate that they're talking about changing. So if you hold an investment for longer than a year, today the capital gains tax for most of us is 15%. It can run up to above 20% for those on the high end. And President Biden is talking about capping that at the top end of around 40%. So basically almost a double in what the capital gains tax rate will be, which could have implications on how much money people make, how much do they pay in taxes, and will it be good for the market, bad for the market. And initial news, even though he talked about this during his campaign, the initial news was not positive. Now, long term, what does this do to the market? No one really knows, but I'll give you my thoughts, and I'm sure other people have talked about this as well. Most of the people who are impacted by this increase are probably not paying high tax levels as it is because they have CPAs, they have businesses, they find ways to lower their tax bracket. So part of the frustration on the media side is they talk about this and they make it seem like it's going to apply to all of us, which it's not. One thing also to remind is the reason for the tax, depending on what you value, is to go towards education, free community college, kindergarten for kids. So the money is supposed to be going to be for things that I think as a whole we would probably appreciate. Having better education for our kids, better college. Those at the top end are probably doing okay, but still it's a huge increase, and I understand why people don't like it, but not everybody is going to see that increase to that level. But these people have also made their wealth through investing. They understand investing and the value behind it. So my 2 cents is, I think if this were to get passed, and this is still just at the very early stages, so again, a lot of noise for something that's just being floated. Chances are, as we know with politics, it's going to be negotiated, it's going to get knocked down, there's going to be some type of compromise, and who knows where it ends up. But those people with long-term gains will probably sell because they want to capture it. They know that, let's just say for illustration point purposes, 2022 is when the capital gains rate is going to go up. And you're sitting on capital gains and you're going to see this increase from 20 to 40%. Well, if you know for a fact your taxes will be higher next year, you would take the gains this year, pay it at a lower tax rate, reestablish your baseline, and then move forward. And there are strategies with tax planning that you can do to minimize your taxes. You can do tax loss harvesting where you offset gains with losses. There's lots of things you can do going forward to minimize the amount of taxes you pay on your investments. But I do think there could be a short-term sell in the market for people to realize gains, but they understand that one of the best ways to grow your wealth and achieve wealth is through investing through U.S. equities for the long term. So you pay your lower tax rate, you reestablish your position, you can go right back in if it's a gain, and then now you have a new starting point for next year's higher tax brackets. Your gains would be less. So I don't think that this is something that crashes the market. I don't know, I don't have a crystal ball, but if we think about it, where else are these individuals going to go put their money to work to grow for them, because that's what's worked for them in the past. The other thing they're talking about changing is the estate benefits. So today, if I were to accumulate massive wealth in investments and I didn't sell them, so again, this capital gains is only realized when you sell. So if you're sitting on, $3,000 of gains, if you don't sell, you're not going to have to pay that capital gains. It's not until you sell it, at least the way the tax code works today. If I'm sitting on all these gains over years of being responsible and planning, and I pass away, then the boys, when they inherit today, they would be able to step my cost basis up. So let's say there's $500,000 in gains, I pass away, my cost basis was way down here, the boys get it up here, it steps up, and all of that capital gain that I had achieved, they don't have to pay taxes on it because they get to reset their cost basis at that new level. Then they could sell it in the future, have much lower tax bracket or tax consequences. So they're talking about also revisiting that and having some type of cap of how much can be passed that way, so that wealth is not continuing to be passed on from generation to generation without it being taxed. I don't necessarily love that, but I understand why they want to look at that. At the end of the day, there's going to be a lot of talk about this, a lot of fear about it going to crash the market. I think you see a short-term reaction to it, but again, where are those individuals going to go put their money to grow it for the future? And their investors, they understand the markets, they understand the benefit, and there's planning that can be done. So if you're a CPA, probably going to be pretty good job security going for the future. Same thing with financial advisor, because we have to figure out how do we work through these changes in tax laws to best serve our clients. So I feel like those jobs are going to be pretty secure for the long term because of changes like this with different administrations. So anyways, I went longer into that than I planned on, but I did want to just kind of touch base on those things. We'll finish out with a kind of sad story, but it's also not sad story. It's a lesson. I don't share it to humiliate the people in here. I mean, they're in the Wall Street Journal, so they volunteered to tell their story. But a story of three friends who were trading during the GameStop era on Robinhood. They actually got started before that happened during COVID, but it tells a story of them investing, not fully understanding all the rules to investing, seeing their accounts go up, and then seeing majority of those gains go away. A couple of the gentlemen actually lost some of their original principal, which is a risk in investing, but it's just a reminder that don't get caught up in the hype. Don't get caught up in FOMO. If you don't understand what's going on, even if you see people making lots of money, chances are a lot of them are not going to end up maintaining that wealth that they might create. So just a cautionary tale. It's fun. Do it with an amount of money that you can afford to lose or see not really do anything. Don't take your savings to go do something like this, no matter how easy it may seem. It rarely works out that way. It's kind of like Vegas. The market is always going to win, just like the house is always going to win in Vegas on the large scale. You'll have some people who get lucky from time to time, but Vegas wasn't built on everybody winning. Neither was the stock market, and there are behavioral reasons to that, but also just systems that are kind of embedded in there. You knew GameStop was not going to end well for a lot of people who got in late. We all knew that, yet people still piled in. So it's just a cautionary tale. I think something like this will be a story, a movie one day about everything that went on and the people who made the money and the excitement and the hope and then just saw it all come crashing back down. Thankfully, it sounds like they're all in good shape. They're back to work, which is a good thing. But I just share that because inevitably it's going to happen again. We're seeing it right now with Dogecoin, with cryptocurrencies, or even sometimes with Bitcoin as well. So just if you don't understand, even though there's excitement, sometimes it's okay to sit it out. At the end of the day, traditional, boring, safer, diversified, low-cost investing will still do the job that most of us need it to. We don't have to partake in that exciting, sexy investing that doesn't always play out the way we hope it will. Even if it gives us a taste of victory early on, usually defeat walks itself in and humbles us and brings it back down. So learn from their lessons, learn from others, don't create it yourself, and that's why I shared this story this week. So that's it. Hope you had a great week. Thanks as always for tuning in, and be sure to check in on Friday's episodes of The Pursuit. This last week I talked about how fear is not real, encouraged by a conversation that a friend of mine had with the AGC this past week, talking about fear not being real, which is part of it. So with that, I will let you go. I'm going to go make breakfast for the boys. Have a great weekend, and we'll see you all in the next episode.